Hello, everyone, and thanks for joining us this month for Side by Side Digital. I'm your host, Rebecca Shively, and we've got a great episode lined up for you today. This month, we're talking about the true cost of homeownership. Whether you're building, buying, or remodeling, there are lots of expenses associated with maintaining and upkeep of your home. And we know that those costs can definitely affect the financial decisions that you make in your farming operation. So we're really happy to be joined today by two of our experts. Lisa and Scott are with Rural First. We're really excited to have them join us today and walk us through some of those things we should be considering when talking about the true costs of homeownership. So Scott, Lisa, thank you so much for being with us today. We'd love to know a little bit more about you. Lisa, why don't you tell us a little bit more about you?
Thank you for having us, Rebecca. My name is Lisa Reichert. I am based out of the Baldwin office, just south of Kansas City. I live on a farm in Paola, Kansas. My husband and I have two boys farm corn, soybeans, wheat, and run a calf operation. I previously to working at Farm Credit, I've been with Farm Credit for 3 years. I sold real estate. So it's welcome, everybody. It'll be fun to be with you today.
Thanks, Lisa. My name's Scott Sandstrom. I've been with Farm Credit for about 4.5 years. I've kind of been a journeyman, I guess. I started in crop insurance, then I became an ag officer for 3 years. And then just over a year now, I've been with Rural First and serving in Southeast Kansas. Me and Lisa both cover Southeast Kansas. She has 6 counties kind of around the Kansas City area. Then I cover everything south to Oklahoma and over to Missouri.
Rural First is our consumer loan product. All of our consumer loans go through our Rural First program, which is partnered with Farm Credit Mid-America. Farm Credit Mid-America is located in Louisville, Kentucky, and they work with us on all of our consumer loans. So the consumer loans is going to be any land you would purchase to build a home, construction loans, home on lands.
So kind of to get started here, kind of lay out what we're going to go over today. So we're going to visit on a couple things, kind of what underwriting looks for, preparing your financials to get it approved for a loan. Also kind of go over kind of your goals and what it looks like when you're going to build your first house or purchase your first home. You know, for most folks, your home is your largest asset on your balance sheet and also could be your largest liability. And so we're kind of working through some of those things there and kind of get you guys in the right place so you can kind of start thinking and planning for your next purchase. And so we like to think that you don't wake up and decide to build a house that day. It takes some time, whether it's 6 months or a couple of months, just kind of prep and get ready to go. So the first thing we'll go over today is one of our first products, which is our lot loan. Lisa and I probably do majority of our loans are probably lot loans, I would say. It's one of all our products are really good, but this is kind of second to none to what competition does out there. Our lot loan consists of anything you intend to build on. And so whether it's 5 acres, 10 acres, or 160 acres down the road, any piece of ground you purchase and you intend to build on, we consider it a lot loan. Even though you have intent to build, we don't care if you build right away. We like to think if you build the next 5 years, but there's no time restraints we do on that with our lot loan product. Again, we talked about the no acreage limit. That's huge. With what we do and who we serve, we want to give the best options for the borrowers. So with part-time, full-time farmers, we're able to service those guys in the way they want to be served. I made a comment down here on minimal down payment. It's 15% down. If you guys have been Farm Credit customers, that'll probably surprise you. That's a really low down payment for our products. And that gets you a 15-year fixed rate, which is also great. When we talk about competition, what other people do, other banks may do 20% down, but they're going to give you a 5-year fixed to amortize on a longer term. And so we kind of pride ourselves on doing long-term fixed rates to help out our customers. And that's one of the things there that we do really well. I think that's it for lot loans. So now you bought your lot loan, we'll go on to building your house, and Lisa will take it from here.
So once you are ready to build your home, we can combine your lot loan and your construction loan into one product and one loan. We have some really great things about our construction loans. We can lock our rate up front. In this environment, that's really important. The rates are continuing to rise, so it's nice to be able to lock your rate in the beginning of your loan instead of waiting to do it at the end with the permanent, because it is a permanent loan from the beginning. It is a one-time closing. We do not do construction to perm. We just close one time, and then we monitor throughout the loan process. We do require that you have cash reserves. It's very important that when you go to build a house, it's a little different than purchasing a home. There tends to be some unknowns. So we like to see that you have 5% in cash reserves. In a savings account, we do not escrow or hold those funds. We just verify that you have those funds. We can use, for farmers, we can use cash reserves as grain in the bin. So if you do have grain on storage and you're not wanting to sell that, we can use that for your cash reserves. Also, I'll skip back to the top. Sorry, I kind of skipped down. Will allow you to do have a general contractor, or you could do self-contracting, or what we call limited self. So limited self would be if you have a general contractor, but you're doing a lot of the work yourself. We tend to have that happen a lot with farmers, because farmers have a lot of equipment and they may have the ability to do some of the work themselves. So we will allow that, and then you can use that as sweat equity in your home. We also do a variety of different homes. Of course, your traditional stick-built home, that's we do those all the time. But one thing that we do, a lot of lenders will not do, is we do what you would call a shop home or a barndominium type homes. We finance those. Scott and I receive calls on those several times a week. They become very popular in the rural areas. And so we do constructions on barndominiums and shop homes.
If you're not going to build a house, obviously your next option is to buy a home. And one thing we do here is obviously full-time, part-time farmers. We have no restrictions when financing full-time, part-time farmers. And what I mean by that is if you are a documented farmer on your tax return or through a barter agreement, we can finance you, whether that's a house in town or house on acreage. We can do either one. If you are not a part-time farmer and you want to use Rural First, you consider a non-farmer, we cannot finance folks in areas that have population over 2,500 people. And so we are truly here to serve rural America, full-time and part-time farmers. Where we can lend, I kind of got into that a little bit. If you're full-time, part-time, we don't care. We'll finance your house, any structure you want to buy, kind of across the countryside here. And again, if you are not a documented farmer, we can only finance homes under 2,500 people. One of the main things while we win a lot of deals and buying homes is the acreage restrictions tab I have there. So most banks will do up to maybe 10, 20 acres on secondary market. They'll sell that loan off. You won't know where that loan's going. It'll be sold multiple times. Whereas with what Lisa and I do, if it's your house, we don't care what it sits on, and whether it's 160 acres, half section, full section. If it's your primary dwelling, we could finance that thing. And we have the ability to do it again for 15% down, 30-year fixed. And one thing we haven't highlighted yet on that as well, especially for young guys, is we don't have any PMI, which is private mortgage insurance. And so most institutions you would work with, they require 20% down to avoid having that private mortgage insurance. And that fee can be added onto your mortgage. And it's based off of your credit score and some other things there, but it could be substantial depending on how things look. And so we're able to get down for lower down payment to 15%, plus we can avoid the PMI, which makes a big difference in someone's cash flow and what they're wanting to do. On second home vacation homes, it's a newer product that we've had. We haven't offered prior, but if you're a full-time farmer and your wife wants you to buy a house in a lake, we can do that for you. Now, whether you tell them we can or not, that's up to you, but we're here to help you guys out in all facets of your operation. And we're able to kind of do different things and do the second home, vacation home. If you want to buy a rental house for your kid to live in, things like that, we can help you out and finance all your needs from that standpoint. So that's buying a home. And now, what if you buy a home and needs a bunch of work done, like some of these old farmhouses we see out there? That's where Lisa can help you out.
So one of the things that I think is kind of exciting is that a lot of young farmers, maybe they've bought grandma's house or they bought a piece of land that they're going to run cattle or farm on, and there's an old home on it that they would like to live in, but maybe that home needs some repair. So we can do a remodel and repair for your home and tie that into one loan with your purchase when you go to purchase that property. Let's say you're purchasing a house on 80 acres and you're going to run cattle on it, and that's kind of your intent as the farmer, but you're like, well, this property has a house that needs a lot of work and it needs maybe $60,000 worth of work. What we'll do is we'll just take the bids and do an as-will-be appraisal, very similar to our construction loans. and we'll be able to lend you the money to do the repairs. Also, we can do the same. Let's say that, maybe grandma gave you her house. Maybe she gave you your house and 80 acres, and you're going to move into that. And you can we could even do an as is appraisal on that if you have equity in the property, and do the remodel repair. So that's pretty exciting for a lot of young farmers, because a lot of them do live in older homes out in the country that maybe were once owned by somebody in the family. And the next we'll go to the checklist for success. And I'm going to start off there. There is some things that we will need. We'll collect your financials. Our process is a little bit different. If you're within the farm credit system already with your ag loans, on the consumer side, we do have a few standards that the ag side does not have. We'll need to collect the tax returns. We do have, and typically with the farm credit loans on the ag side, they just collect a couple years of tax returns and a balance sheet. We will need a little bit more documentation on the consumer side, but we'll walk you through that as we go. We do have specialized underwriters for our farmer loans. So when somebody is a farmer, whether it's part-time or full-time, but especially with our full-time farmers, we have, when you're a farmer, you file a Schedule F. Those are very important, and we're going to go over the Schedule F form with you, and we want to point out why it's important to pay attention to this if you're wanting to buy a home. On a consumer loan, we have to show repayment on every loan, and to make sure that you can repay that loan, and we are held to a little bit different standards with the government than on the ag side. So if you look at this first tax return, it shows that this farmer, he ran cattle. He had a gross income of $50,326. And then it shows his net income down below. And he did have a lot of write-offs. Rebecca, can you move? Thank you. So you can see where he wrote off quite a bit, and his total expenses exceeded his growth. So he had a negative income this year of $47,808. If you go over to this column on the left-hand side, it shows that he had $9,749 in depreciation. And he also had some interest of $485. We can add that back to his negative income to show his true income. It still leaves him with a negative income. So unfortunately, this borrower, if this was his only income, he didn't have W-2 or something to offset it, we would not be able to do a loan for him because we cannot show repayment. So this is one of the reasons we have this in here, is because we wanted to show you that it is important to be able to show some income. And like I said, if you have depreciation or interest, we can add those two back in, but we can't add back in expenses. Now we're going to go to the next slide that's going to show us another farmer. This farmer had crops. And this farmer in particular was one I did a loan for. He did have some off-farm income too, but on his Schedule F, it shows his gross farm income was $98,032. And then we'll scroll down, and it did show that he had a profit of $28,811. Over here on the left side, it shows his depreciation and his interest that we added in. So we did have some income from the farm to be able to use. And then we had one more we wanted to show. This was one I believe Scott did the loan for. It's a grain farmer. And his gross farm income was $309,418. And then his his net was $26,911. But if you look over here on the left-hand side, he had $64,665 in depreciation. And then his interest, he had $9,063. So he, had $100,000 close to it profit that we were able to use for repayment. And these all, just so you know, all of these were young and beginning farmers. And we can go on to the next slide with Scott to show the rest of our checklist.
Thank you, Lisa. Some of the things to look at when you're looking into building or buying your house is collateral options. And so being young and beginning, we have these conversations all the time with folks that are, fresh out of college or just going back to the family farm. They may not have their savings account where they want it to be for the down payment, but they have good wages. They can afford the payment, just can't get into it. And so for collateral options, what we want to talk about there is things that we've seen is we can entertain gift letters. And so whether it's financially or gifting land, sometimes folks will give their kids $30,000 in a gift letter, help offset some of that down payment, and or like Lisa talked about earlier, if you're building a house, you have to have 5% in cash reserves. That's after your down payment and paying closing costs. And so that gift letter can offset some of those savings accounts that may not have accrued yet just because of age and getting started. The other thing too is for land. So if most folks that are on the farm and building, they have access to land in most cases. And so if the dad wants to give his kids 20, 30, 40 acres or whatever it is to build on, that ground is free and clear. Obviously, we would appraise that dirt plus your plans to build, and that total value, we would then generally lend you 85% of, obviously pending repayment, things like that. And so that's one way we get younger guys into their dream homes, and options there is by having those options from a gift letters or giving of land and offsetting that. Now, the credit bureau thing is another one to talk about. Building credit is very important, especially at a young age. Having your first credit card or being on your first, cattle note, having banks that report that. Now, with Farm Credit Service America here and Frontier, all of our loans are reported as a credit bureau. So if you're a customer with us, you're building that credit. There is some banks out there that don't report, and so your credit's never growing. And so in some cases, no credit is just like bad credit. With Rule First in our products, obviously the better credit score you have, the more options you have from a rate perspective and a loan perspective. If you have no credit but your credit's low, sometimes that may cause a higher interest rate or things like that. And so the importance of, if you're thinking about building in the next year, kind of get an idea what your credit score is, and start working towards ways to build that up. That way you have the best chance at approval. And then looking at approval, we kind of talked about repayment with those tax returns and reviewed some of those things. Now, one of the main things we look at, and this is probably, I would say at least 95% of loans, if they hit TMO, we're going to do that deal. And so that's total monthly obligations, what that's called. So a simple example when you're looking at your own financials and what you may be able to afford is if your gross income is $10,000 a month, what we want to see on our side is your hard costs are below $4,000 a month going out. And that would be the new mortgage. That would be your farm payments, your tractor payments, your truck, your boat, your camper, all your toys or whatever you got. All those mortgage payments need to be below $4,000 in this example. So less than 40%. If we can hit that number, our standard is about 36%, but that gets us pretty close to where approval needs to be on a cash flow basis.
Scott, if I could add something.
Yeah.
I wanted to add about collateral. If, let's say you're purchasing some property from a family member, let's say dad is going to sell you an 80 and he's going to give you a good deal on it. So he's going to sell it to you. Let's say the land's worth $5,000 an acre, but dad's going to sell it to you for $3,500 an acre. We're going to call that a non-arm's length transaction. And we'll be able to use the appraised value of the property and not the actual purchase price. So if you're purchasing land and it's listed with a realtor and you're purchasing it from somebody that's not a family member, we call that an arm's length transaction. And we have to use either the appraisal or the purchase price, whichever's lower. But in a non-arm's length transaction, we can actually use the appraisal price. So I've had a lot of young farmers that are buying some land from a family member, and they maybe that, they don't have to bring a down payment because their down payment is in the equity in the property. So we can also use that as collateral too.
Yeah, that's a great point, Lisa. And the ones of you that are farm credit customers, it's a little different than the ag side. So on the ag side, if you buy a property, whatever it appraises for, that's the number you use for collateral. On the rural first side with consumer, it's the purchase price or the appraisal, whichever's lower of the two, unless it's a non-arm's length family transaction. Then we will give you the credit for that extra collateral there. So good point, Lisa. Thank you. Next, Lisa will kind of go over and kind of cover what we kind of talked about here and have a brief overview of kind of our products, our main 4 products we do.
Yeah, so the products that we mostly handle is our home loans. Definitely that's a consumer loan. The nice thing is we can do anywhere from a 10-year, 30-year fix. We can do a fixed rate long-term. Minimum down payment is 15%. We have no private mortgage insurance. We can do variable rates if that's what your option would like to go with. The construction loans are a great product. I feel like our construction loans and our land loans are second to none. Nobody can beat them. There's a one-time closing with the construction loans, 15% down, minimum 15% down. And we do not charge PMI again. That is a big hit with a lot of people. Also, we can fix your rate up front. And then the land loans, a minimum 15% down. We can go from a 10 to 25-year fix depending on your down payment. But a minimum 15% down, and just require our that you have intent to build. And then we also do recreational loans. Most young farmers don't typically buy recreational ground, but if you have a buddy that's buying recreational ground, we do that too.
And the one thing I'll add too that we didn't cover that's real important, especially right now in a rising rate environment, is once you have a loan with us, our loans are kept in-house and serviced by us the life of the loan. You have opportunities for very cheap refinances. So what I mean by that is once you've done a loan with us, once you've made 12 payments on any of our products, you can qualify to it and for a refinance. And that's only $500. And so think about it, as rates are going up right now. I know everybody's focused on the rates and I get it. But get your property bought, lock it in, make 12 payments. And hopefully the next couple of years we'll have an opportunity to capitalize on when the markets dip, and you could do a full refi for $500. You just DocuSign. We don't have to do new appraisal. We don't have to do title work, financials, none of that. You just sign the document. We're on our way. So that's another tool we offer here that no other bank can offer. So it's really slick.
And just to add to that, just so you're clear, so on the ag side, we can do annual payments and biannual payments. Those are monthly payments. So it's 12 monthly payments. All of our loans are monthly payment loans.
Yep, that's a good point, Lisa. And that kind of covers most of the topics we wanted to deal now. Lisa and I are down here in Southeast Kansas, but there's rural first officers that cover every retail office across the 4 1/3 states we're in here. So if you have questions or looking forward to building and you want to start getting a plan laid out for you, please contact your local office and they'll get you in touch with one of the rural first. And if you just want to call and visit with me and Lisa, give us a shout. We're available too. So I think we got some time for some questions as well.
Yeah, thank you, Scott and Lisa. We have a couple questions that have come in. And Lisa, you maybe touched on this a little bit already, but someone was asking, how do you establish what bare ground that you intend to build on is worth? I know you mentioned a little bit having an appraisal. Can you talk a little bit more about kind of that process if you're working with bare ground?
Well, the value of the ground is going to be the appraisal. It's appraisal or purchase price, whichever's less. Unless, like I'd said before, it is the non-arm's length transaction, but a lot of it does hinge on that appraisal itself. For my side, like if you want to make an offer on something, I would really lean on your real estate agent on that, on the purchase itself, and because they know the market in the area.
The other thing I'll add on that, Rebecca, too, is, we're the largest lenders in Eastern Kansas down here. So we have more comps than a lot of other folks do. So we do have a good grasp in the areas we work in on kind of a broad area of what the value could be. And plus we have our own full staff of appraisers, just like the ag side too, we can maybe lean on, but we're going to have a good insight on that. But the smaller tracks are the tough ones because generally smaller acreage sell higher than your larger tracks. So kind of pinpointing what that is and what that area, gives you can change some too as well.
Great. Another question that came in, Scott, I think you talked about this a little bit in terms of sometimes having no credit is worse than bad credit. Suppose you have, we'll call it less than great credit. Do you have any advice or tips for people, things they can do to start improving that and kind of building that, especially early on in your farming career?
Yeah, I think, and I'm not an expert on this, but obviously paying timely. One of the biggest things and no-nos for us is when we pull a credit report, your score could be good, but you got recent delinquencies, and that's not looking. Any underwriter sees that, they say, well, why would we give someone money that's proven they can't pay us back, right? So, being timely, setting up auto pay, making sure those first couple draws are pulled auto. Because a lot of things we get back from folks is like, well, I thought it was on auto pay and it ended up wasn't, right? Well, unfortunately, that still will hurt your credit. And so I would just suggest pay timely, pay ahead, set alerts on your calendar every 2 weeks to check your credit card, what it's at, pay it ahead of time. But I think that helps too, and just kind of being conscious of what you're doing and what your goals are. But there's no quick fix to credit. It's fast to get it to go down, but getting it back up takes a little bit of time. So just being conscious of where you're at financially and getting things paid timely is huge.
All right, some good advice there. Here's kind of another one for people maybe starting out, but can you give us an idea? I know markets are kind of crazy right now and things are moving fast and it's real competitive. Is there a typical timeline that someone might expect in terms of pre-approval to the actual loan? What should people be kind of planning for in terms of a timeline?
I will take that. So, and this can vary depending on the financials, but I would say once you contact your Rural First Loan officer, and they will send you a worksheet to fill out for the pre-qualification, and you send that back to them, they should have that ran within that 24-hour period for the pre-qual, and then they're going to send you a link for the full application. The sooner you can get all of those financials to the Rural First Loan officer. If we do have some of your financials on file at Farm Credit, with your permission, we can use those and help move the loan along faster for you. Once we have all your financials and we've submitted everything to the underwriter, typically we get an approval within 72 hours.
Suppose you're kind of torn between maybe a large purchase for your farm, maybe a new piece of equipment or renting some additional ground, but also trying to buy that first home and saving up for that down payment. Do you have any advice on how to evaluate or work through that scenario, kind of balancing growing your operation, but also trying to grow your family too?
Lisa, I'll take some of this, but you might have some perspective as well. I think a lot of that comes down to what's your current living situation. Are you renting a home right now that's going up for sale that you got to get somewhere, or are you living with your family but you want to get on your own and start your own family? I think it's one of those deals you got to set out with head of household, if it's you and your wife or whatnot, kind of break down where you're at right now, what's your goals long term, because most people know if it's a place to rent, that's probably a one-time opportunity that you may have to just take advantage of and put the house on hold for another year or two or whatever it looks like. But that's what I would say is just kind of sit down, really think about it. Think about your long-term goals, especially in ag right now, you want to be growing. And so that's probably one of those things you have to decide as a household. But that or just do what your wife says is what my wife would tell me to do. So but good luck with that, however it works best. But Lisa, what do you think?
I would say too, in addition to that, be careful about purchasing things that aren't growing your operation, like maybe a fancy new truck or toys, things like boats and things like that, because it's not really helping your operation grow, and it's not something you can write off with depreciation. So I would, we can add that back in on depreciation when it comes to income. So I would just be focusing on your operation and your family and not so much on the toys at this stage as a young and beginning farmer. So you have that money and you don't have lots of payments to show, so you can show repayment for your loan.
All right, definitely some good advice there. We've got a couple more here that are some folks already using Roll First, so that's great. Someone says that they're currently in the loan process and they need to have a co-signer on a construction loan. Would they be able to refinance the loan after 12 payments to eliminate that co-signer on the note? That might be a little specific. If you can't answer that, that's okay.
I'll take that one. Yeah, yes and no. So it kind of depends on your situation. Yes, you could refinance loan. Now that would be a little different than what Scott was talking about earlier. So his was more of a rate conversion. The rates drop. We can do a rate conversion for $500. A total refinance would be what you would have to do to take somebody else off the loan. And you could do that actually any time during your loan. It doesn't have to be after 12 months. But you would have to be able to show repayment on your own. So yes, you could, as long as repayment could be shown.
All right, kind of another current Rural First question. Someone says that they have a loan for their acreage and they'd like to build a shop someday. Is that something that we would finance? And if so, how much equity in my acreage is used to secure the existing loan, and how much would I need to build the shop?
Okay, I'm going to take that one too, Scott. So there's a couple different options. Your farm, your shop, it's going to be ag use. Even with being a Rural First loan, and that's held by Farm Credit Mid-America, you still could go and ag leasing program if that was beneficial for you for your taxes. And Rural First would allow you to have that ag lease on your property. So you have a couple options there. You could also build that with Rural First. And the Rural First loan officer will get with the ag officer, and they'll sit down with you and show you what is the best option for you to make. So yes, you could do that. And then if you decide you're going to build a house later and you come back to the Rural First loan officer and you're going to build your primary residence and that ag lease is in place, it's okay. We're okay with that ag lease being in place. So I hope that helps.
Yep, that was a good one, Lisa. And then again, if you had equity in the property, you could reappraise it, do an improvement loan, and finance a shop as well. So you'd have a couple options there.
Can you talk about, are there any special programs for young and beginning or first-time home buyers?
I'll go, Lisa, give you a break here. So we don't offer like a true first-time home buyers like you may see advertised on Facebook or online, where they'll give you the down payment as long as you live there for a certain amount of years. It'll be forgiven. Unfortunately, what we do, we're not able to participate in those. The best thing for first-time home buyers or people getting started is FSA has programs that we can do joint loans with them, or they would finance 50%, we would finance 50%, and so you'd have a 100% loan. Or there's a 50-45-5 they offer, whereas you put 5% down, FSA would cover 45, we would do 52. So that's one option we do. We do participate with a farm service agency on some loans as well. The other thing that we talked about earlier is I more commonly see gift letters or funds or dirt from family support more so than going through FSA. But that's kind of the main two options if you don't have the option of a co-borrower or either co-sign with you too.
All right. I'm wondering if you can give some advice. I think you guys mentioned you're pretty busy this time of year and you see a lot of different scenarios. Is there any advice you can give in terms of mistakes that you see people make in this process when it comes to either buying or building, and maybe some ideas for how to avoid those or how to be proactive about it?
I think I'll go for a little bit, Lisa, if you have any thoughts. I think the big thing with this stuff is plans. Now, a lot of the phone calls we get are people will never plan on buying this property, but it just came up behind them. They want to have it, but maybe they haven't been thinking about their cash reserves, or, well, we just bought a new truck, so we didn't think we were moving. We have this big debt now, but it's 0%, so it's not a big deal. Well, it's still a payment, right? So I think it's hard to forecast everything in your future, what it looks for, but I think just having a financial plan, every year sit down and say, what do we need to do to this house? Are we happy here? Are we going to be looking at doing a remodel? Are we looking at moving? If something bias came up, would we be willing to move? What's that look like, I guess? And so it's hard to think too much, but always reviewing your goals as a family and an operation and looking at your finances and see if those align with what your goals are. And that way you are prepared if something comes up and you can jump on it. So,
Lisa, anything you wanted to add on that one?
I really think Scott covered it. I agree. I think have a financial plan. Make sure that when you are purchasing vehicles, items like that, that it is something that can fit in if you do decide to buy a house or build a house within a payment that you can't afford it.
All right. I think we got a couple more questions in here. Looks like we still got a little bit of time. You talked a little bit before about interest rates and how it looks like they're kind of up and down these days, maybe starting to be on the rise. Any advice that you have for folks making to make a move soon?
The interest rates have went up a little bit, in the last couple months. And it is hard for people sometimes to adjust their mind around, when the rate was at 3%, 3.1 for a 30-year fixed home mortgage. And now we're looking at the low 4.35 is our 30-year mortgage today. So it's a little hard to wrap your mind around that after, it's been down in the threes. But just remember that the rates are still really good. Those are still historically excellent rates. And I would just be conscientious. It's all about your repayment, and it's not going to change your payment that much when it's just a little bit of difference on a 20 basis points here. I would just stress that be conscientious on the purchases you make, that you still can fit in home ownership in there. And like I said, the rates still are a really good historical rate. But Scott, do you have anything to add to that?
Only thing I would say that I talk with most borrowers on is, again, like we talked about earlier, that refinance opportunity to, convert that rate for $500 helps offset a lot of the concerns on rates down the road. So, I think back to my home purchases, I bought 3 houses in the last 7 years, and I've refinanced twice. So I've done a lot of loans to myself, but it's one of those deals is when you can capitalize on a lower market, take advantage of that. And so just thinking back over the last 7 years, there's been a lot of rate opportunity. Who knows what the next 7 years look like? But if you get into what you think is a higher rate right now, just know that next couple of years, there'll be an opportunity to get down to something cheaper too. So.
All right, some good advice there. Oh, looks like we maybe had another question that just came in. Can you refinance your loan more than once?
Yes, on the rate conversion program, you can do that once a year. So it is a little different than a full refinance. So your maturity date is going to stay the same, but every year you can do that. So if you did it after you've made 12 months worth of payments, then you can you're eligible for a rate conversion. Then the following year after that year is up, if the rates drop again, you can do it again. Yes, you could also do a full refinance if you wanted to.
And I'll add on that too, Rebecca. So just more detail on that. If your payment is not going to increase by more than $300, you can drop your term length. So let's say you did a 30-year note, you paid for 3 years, rates are dropped, and now you want to get our 25-year fixed rate. As long as your payment does not go up by more than $300, that's just a conversion. We're down to that. If you're trying to go from a 30-year to a 15-year, and your payment, and that is up over $300, then we would have to do a full refinance at that time. But most people would just kind of capitalize off of the short-term change. Just if you've already paid 3 years, you can do a 27-year note, or you can go to the 25 as long as the payment doesn't go up by more than $300. So,
one other thing I want to add is that we don't have prepayment penalties on our loans. So let's say you have a 30-year loan and the interest rate is a little bit higher the longer the term. And if you pay extra every month, you're going to beat that interest rate by paying that loan off early. We do not charge you a prepay penalty for if you got a loan with us and you paid it off 6 months later, there's not a prepay penalty.
Scott and Lisa, thank you so much for joining us today. If you wanted to give one piece of advice to leave our audience with today when it comes to kind of getting into their first home, what's something you'd like to leave the group with before we call it?
Call Rural first, and even if it's 6 months down the road, our pre-approvals last 6 months, and so it's always good to be ready early, especially in the market we're in. And this spring's gearing up to be probably crazy again. Is be pre-approved, because when you make that offer, it can make the difference between you having your house and not. So that's what I would suggest.
And I'm just going to reiterate what Scott said earlier about having a financial plan. I think that was great advice. And, save money or grain in the elevator. Grain in the bin, we will use that towards down payment, towards cash reserves. Just be really conscientious of your spending. And that's just the advice I have to give. And I think Scott said it earlier, and I thought it was perfectly said.
Well, again, thank you so much, Scott and Lisa, for spending some time with us today. And thank you in the audience, some really great questions that came through. Obviously, this is a complex topic and lots of details to consider. So we really appreciate your time and spending some time with us today. We'll be back next month on Wednesday, first Wednesday of the month. That'll be April 6th. We're going to have a special guest in April. In April, we're usually thinking about planting. We're thinking about weather. We're going to be joined by Eric Snodgrass. He's going to give us a weather forecast and talk about how that might influence some markets. So definitely don't want to miss that one in April. We hope that you'll join us next month.
Thank you, Rebecca.
Thanks, everybody.